Owning dividend stocks can be one of the best or worst investment decisions that you make. What I'm talking to you about today is 3 dividend growth stocks that have grown their dividends for 50 years plus. They all yield 1.5% or higher, but more importantly, they are positioned to continue paying and growing their dividend for the foreseeable future. And what data shows is that stocks that grow their dividend outperform the stock market over time. So that's what we're looking at today. All right, the 3 stocks are, I'm not hiding anything from you, right? Lowe's, Illinois Tool Works, and Abbott Labs, right? And so one sign that a stock is undervalued compared to where it's traded at recently is if its dividend yield is above its 5-year average. And so Lowe's dividend is 22% above its 5-year average. In this case, it's because the stock price is down, but they've also been growing the dividend very fast. Dividend yield is currently 2.18%. They have a PE ratio of 13.4. It is below its 5-year average. It gets a very safe rating. They grew at 31% in May of 22. Over the last 5 years, they've grown at 18% on average. And then you can see the dividend growth streak is 59 years. Their payout ratio is 27%. That payout ratio, if it's lower, that means there's room for them to continue paying their dividend from earnings and also increasing that dividend, right? If the payout ratio gets too high, they either have to cut it or stop raising the dividend. And then free cash flow has been positive in each of the last 10 years. That's the type of company we want to see in this macro type environment. All right, so check it out. Just some highlights of Lowe's most recent results. They booked $27.5 billion in sales. That was only up 0.2% for comp sales, so it is getting tough out there in the macro environment. Gross margin was 33%, which was down a little bit. That means, yes, they are having to be more price conscious. Consumers are more price conscious. Operating margin was higher, meaning they are getting efficient and staying efficient. And then they booked a $4.67 diluted earnings per share, which was up almost 10%. And this is what we love as dividend shareholders, right? $4.5 billion paid to shareholders through dividends and share repurchases. Okay, and if we look at Lowe's historical stock price, we want to own stocks that outperform the market. Over the last 20 years, it's up 12% per year compared to the S&P 500, up 8% per year. It's turned a $10,000 investment into a $113,000 investment over that 20 years. Pretty awesome. And then even if we go just back to 10 years, still massively outperforming the market, 22% to 12%. And if we look here, just roughly looking, it has over the past 10 years, traded at a normalized price to earnings ratio of 20. It's currently down. This is a blended price sales ratio at 14.7. You can see here, this is below the blue line here, as well as the orange line, which is the price to earnings growth rate, right? So if it gets back up there, then you've got some nice returns as a shareholder from stock price appreciation, plus you get the dividends on top of that. All right, next, jumping into Illinois Tool Works. Not looking quite as undervalued as Lowe's. The dividend yield is 4% above its 5-year average, a 2.45% dividend yield. Its PE is a little bit higher, 22.7, which is in line. It's got a very safe rating from Simply Safe Dividends, only 7.4% dividend growth the past year, 14% over the 5 years, so still really strong. 50 years of dividend growth, and you can see the payout ratio is different, right? 57% for them, so a little bit higher than Lowe's there. Free cash flow has been positive in each of the last 10 years. Oh, and looking at this, recession talk, Lowe's actually increased their dividend from 07 to 09 during that recession, and Illinois Tool Works did the same. They increased the dividend from 2007 to 2009. And just to give you an idea of the different segments of Illinois Tool Works business, they have 19% of revenue coming from automotive, 14% from construction, 14% from food, 13% from polymer and fluids, 13% from specialty products, 16% from test and measurement and electronics, and then 11% from welding. $14.5 billion in total revenue in 2021, 24% operating margin, and then 19,300 total patent portfolio. So this is a business that will get hurt in a recession for sure, but these types of things are, not going away. Looking at Illinois Tool Works, their performance over the last 20 years, up 11.5% versus the S&P 500, 7.8, so beating the S&P 500 there. If we go to the last 10 years, 17.5% versus 12.79. So again, outperforming. We love to see that. Then it is, like we said, Lowe's was way undervalued here, at least compared to where it's historically traded. Illinois Tool Works is actually trading a little bit above its 10-year average price to earnings ratio, and the growth isn't expected to be all that strong, right? So, maybe we can wait if we're interested in the stock and just follow it. Looking at it under 200 down to about 180 or so a share is certainly a better buying opportunity. But if you're looking for the income and the dividend growth, this is a solid company to consider. All right, and finally, Abbott Laboratories. Dividend yield is 18% above its 5-year average, only a 1.89% dividend. It's got a 24.3 PE, which is in line. It gets a safe rating versus very safe. 4.4% dividend growth, so a little bit slower there. 12% dividend growth over the last 5 years. 50 consecutive years of dividend growth. A 33% payout ratio. Positive free cash flow, and they too increased their dividend from 2007 to 2009. Quick look at Abbott. 130 years of innovation. They're in 160 countries, 113,000 employees, and $43.1 billion in total sales in 2021. Their different business segments are cardiovascular care, diagnostics, diabetes care, nutrition, neuromodulation care. I know exactly what that is. Branded generic medicine. And so some of the names you may have heard, Binax Now, Pedialyte, Similac, Ensure, different brands like that. Jumping over to Abbott, they are, the one that has outperformed the least over the last 20 years, up 9.3% versus the S&P 500, up 7.8%. Over the last 10 years, they're up 15% versus 12.8% on average from the S&P 500. And if we take a look over the last 20 years, it looks like it's a significant discount to its average PE, but let's shorten that up a little bit, bring that average PE down. The average PE has been 23.7. Still looking undervalued. The earnings growth is looking to shrink actually in 2023, and then analysts are expecting to get back up to about 9% growth. So given that, if it gets back up to that average of 23.7, not saying it will, then you're looking at an annualized return of 8.5% for a total return of 19% from now until 2024. And you got to remember, you got that dividend on top of it too, if dividends are what you're looking for. Let me know if you own either of these companies, what you think about them, and if you have any stocks that you want me to review, just drop it in the comments below. If you want to support me, the best way to do that is to like the video, subscribe to the channel, and check out my links below. I have my email newsletter, as well as you can follow my portfolio on Savvy Trader. Both those links are below, completely free.